Stocks recover after a sharp drop earlier at start as silver linings from the US tariffs emerge even as uncertainties about the future linger. Pharma and utilities are the big gainers while IT is the big drag.
US President Donald Trump slaps hefty tariffs of up to 50% on trading partners, disrupting the world trade order. Economists expect this to dent global growth, fuel inflation and royal markets.
Exports from India will attract a high reciprocal tariff of 27%, but less than that imposed on China, Vietnam, Indonesia and Bangladesh. This can boost the textile, electronics and other exports, even as drug makers cheers being excluded from the tariff ambit.
Experts are aghast at Donald Trump's method of tariff computation that ignores real tariffs and expresses trade surpluses as a percentage of exports. Some, like India, gain from this novel formula.
An RBI letter to Bajaj Finance expresses its displeasure over lapses in maintaining and managing data of co-branded credit card customers. It directs the lender to take corrective steps. Bajaj Finance is yet to respond to CNBC-TV18's query.
You're with us live from the CNBC-TV18 Motilal Oswal studios. You're watching Halftime Report. I'm Hormuz Patakia. With me as always is Mangalam Malu. Not as bad as feared, Mangalam, as the morning screen was indicating. You would take this with both hands. You would.
In fact, to be very honest, it was in the morning, the GIFT Nifty was indicating a Donald Trump-sized hole in the market, a 400-point downtick. But then turns out it is a Donald Duck-sized hole in the market, not a Donald Trump-sized hole. And the important part is that, for whatever it's worth, the global uncertainty and all of that and stuff, we still have a significant amount, nearly 2/3, if not more, of our GDP coming in from the domestic consumption. The other part is that even among the countries that we export to, US accounts for just about 18%. And in that, a large part is export of services. And the other part is export of pharmaceuticals. So what is left is very sector specific, very stock specific. And in that as well, the other benefit is that the others have been taxed a little more than us, so we tend to benefit from that, and that's something that we're seeing in the textile space, for instance. And I'm sure you're going to talk a lot about that in just a bit. But the one sector, the only sector that seems to be impacted by this from a stock market standpoint is the shrimp feed sector, which is why we're seeing that big cut in Avanti Feeds and the likes itself. But today, from the market, it's clearly a tug-of-war between the IT pack and the pharmaceutical pack. The pharmaceutical pack rejoicing on being excluded from those, tariffs, and the IT stocks lower on account of fears of growth in the US itself. We'll talk about that as well. But by and large, we're down, but not out. And why do I say that? Because look at the advanced decline hormones. 1,800 stocks in the green for just about 762 stocks, which are in the red. So those lines are far and wide apart. In fact, at the furthest point, after the initial volatility that we saw, in the last 2 hours, it's been like a train track.
Well, someone who had seen the early morning screen and would switch on the TV now would think that this is an error, but no, it's not. The advance decline firmly in favor of the advances. But of course, as Mangalam was mentioning, IT is one sector that is also bearing the brunt. And that is, of course, because of a sentiment impact considering the sell-off on the NASDAQ. And that is after Donald Trump's announcements of a 27% reciprocal tariffs. Now, Jeffries is saying that higher tariffs may impact demand from manufacturing, logistics and retail verticals. Rima is joining in with more on this. Rima.
Thanks so much for that. So broadly, there is no direct impact on IT with respect to tariffs, but the fear is that global growth is going to suffer, and that will hurt the Indian IT companies, especially at a time when valuations of Indian IT company are much higher than their pre-COVID level, and that table will come up for you on your screen. So for instance, in the case of TCS, the current valuations for FY26 stand at 24 times, which is higher than the pre-COVID. We're talking about FY19 valuations. When you looked at it 1 year forward, was at 22 times. And it's a similar, premium for the rest of the large cap IT pack versus their pre-COVID levels. This high valuations comes at a time when growth is struggling. So just putting out JP Morgan's estimates on what they expect IT companies to report in terms of growth in FY26. And we're talking about very low to mid-single digit kind of a revenue growth. So therefore, the question is the high valuation premium justified? The mid-caps are seeing a bigger cut today. Pull up the individual stock price of a Persistent, a Coforge, KPIT, Emphasis. These are stocks which have taken the biggest knock. One reason is they've been ranked outperformers over the last 3 to 4 years on account of higher growth. So stocks have done very well. Persistent, for instance, despite the recent correction, so stock has still doubled in the last 3 years. And here, the kind of re-rating that we had seen in the PE multiples is substantial. So some of that is now being shaved off. So for instance, Coforge is trading at 36 times, Persistent is trading at 45 times, KPIT Tech is trading at 38 times. So some derating is seen. Now coming to what Jefferies is saying as they assess the impact of Trump's tariff orders. They also concur that the IT sector is not directly impacted by Trump's tariff order, but there will be an indirect impact on account of slower GDP growth worldwide. Higher tariffs may impact the manufacturing, logistics and vertical sectors. Also, the slower GDP growth in the US could result in Fed rate cuts. If the Fed cuts rates, then it could be positive for sectors, companies with exposure to communications, energy, utility, because these companies have very high debt. So if there are Fed rate cuts, then their balance sheet is, in a much, in a much more better position, and therefore maybe they will look at cutting tax rates, increasing their tech spends. So therefore they're saying that companies with exposure to manufacturing, logistics could get hit, but on the flip side, companies with exposure to communications, etc., if there is a Fed rate cut, will be positively impacted. So they've done the analysis of the kind of impact that we've seen, the revenue exposure to manufacturing and logistics, and according to the calculation, Tech Mahindra, HCL Tech in the large cap space, IKS and Sagility, these are companies most favorably placed. So for instance, IKS and Sagility get 100% of their revenues from the pharmaceutical, life science, healthcare sector, which is not been impacted as of now. Back to you.
Interesting. The top 3 losers on the Nifty 500 are the principal culprits that Rima was highlighting: Persistent, Coforge and KPIT Tech. Persistent down 9.25%. Coforge is down 6.5%. KPIT Tech also down 6.5% in today's trading session. So IT taking it on the chin in today's trading session. Meanwhile, the auto sector, though, has been exempt from the reciprocal tariffs, although the tariff announcements made earlier, they come into effect today. But Sudarshan is joining in now to tell us how this could have an impact on the sector. Sudarshan.
So reaction of auto stocks will tell you that today's announcement related to reciprocal tariffs was almost a non-event for the sector, because almost all the stocks are down, or some of the stocks are up in the range of 1 to 2%, while some of the stocks like Bharat Forge, Samadhana Motherson, Sona, BLW are down in the range of 1 to 2%. Now the question is, because today's announcement was a status quo, but what has happened to earlier announcement? If you remember last month, President Trump had announced that 25% tariffs on the auto sector, and effective date for the same was April 3. So that 25% tariffs remain, and President has reiterated that has come into effect from today. Now the second point is that baseline tariff. For example, on UK, baseline tariff is 10%. So does it mean that on JLR, tariff would be 10% or the 25% tariff that President Trump had announced earlier? The answer is 25% tariff, because here the auto sector is exempt. So that's the reason 25% tariff will be imposed, not the baseline tariff. Another important point about the USMCA agreement. What is the USMCA? That is the US-Mexico-Canada agreement. So some of the products that these companies supply to other companies are part of USMCA agreement. And some of those companies which are positively impacted by this are Samadhana Motherson, which form nearly 10 to 15% from Mexico and Canada. And similarly for Sona, BLW. So these companies can be positively impacted if the President decides to continue the exemption under USMCA agreement. So overall, it was a status quo, but 25% tariff that was announced last month remains on the auto sector.
All right, Sudarshan, thanks a lot for that. So that's about the auto space. In fact, it remains exempt from reciprocal tariffs, but the 25% tariffs that Sudarshan spoke about imposed earlier will come into effect. Our colleague Parikshit Luthra spoke to Mercedes-Benz CEO Santosh Iyer on the likely impact and spoke about the demand pricing scenario and how business is likely to be going forward as well. So peek into that right up for you.
The biggest impact will be for components, because there is a lot of components exports to the US. There are a lot of supplier ecosystem based out there. Also, I know many component suppliers who also have factories in the US. So they need to see how to calibrate their supply chains. And you made the right comment. This puts inflation up. This puts pricing up, not only for consumers in the US, but also with supply chains getting distorted. There may be an adverse impact on the pricing even for cars in India.
Right. So you are saying that there could be a price increase all across the world, including for the India market as well. Now, in terms of negotiations going forward, and actually before I ask you about the negotiations, the global tariff situation, and we believe that the Trump automobile tariffs are here to stay. They may not be paused immediately anytime soon. Will this, according to you, lead to more manufacturing in the US? Will car makers like Mercedes consider making more? Do you think this long-term bet would be taken?
As I said, I cannot comment on the global strategy, but in general, we even today have a plant in Tuscaloosa. We make 300,000 cars there. So technically, we have a major footprint in the US. Of course, because of the free trade, as I said, we used to sell 50% of that in the US and export the 50%, and we would import the balance 50%. But this has now, we need to take a look at it to see how to balance this. And hopefully there is maybe a better solution, between the EU and the US on their bilateral discussions.
Right. Now, in terms of negotiations between India and the United States, India and EU, what do you think would be the best way forward in terms of reducing automobile tariffs? There is one view in the government that auto tariffs are getting highlighted a lot in bilateral trade conversations, and there is a need to bring them down. The industry does not want any major tariff reductions suddenly overnight. What would be your view and the best way forward?
I get a different sense when I talk to colleagues, mostly from the component industry and even from OEMs. I think the Indian automotive industry is quite now matured enough, and it's time that these tariffs are much more open. The Indian industry can easily compete from imports from the US or from any other markets, because I think the automotive industry has one of the best cost structures in India. And I think it's not easy just because of tariff reduction now for cars to come in and compete with the Indian players. So I think the automotive ecosystem is quite matured. Overall, there should be definitely reduction. As I said, we always advocate free trade. We always advocate fair trade. I would not say zero structures, but maybe if it brings down, it also opens up Indian automotive OEMs to export even further. If you see the last fiscal, the automotive industry has recorded a growth in exports, but it is still to most of the developing markets or to the home country, wherever the OEMs are. So if India wants to participate in the global economy and export, then I think the long run, these bilateral discussions with EU and of course now with the US should help to bring down tariffs both ways. And that should overall help the economy and also drive more manufacturing.
And one more question as we let you go, Santosh. Which jurisdiction do you expect to be most impacted by these reciprocal tariff announcements? Because one, there is a tariff on the automobile sector. The reciprocal tariffs will also impact some aspects of the supply chain of the automobile industry. Which parts of the world and your markets do you expect to be the worst hit in the coming months?
See, to be honest, next 3 to 6 months, I don't think there will be a knee-jerk reaction to move supply chains, because this is, I think, ongoing discussions, if you see, and it's impossible to shift supply chains overnight. But what generally these causes is inflation on pricing, also because of higher cost, vice versa for different markets, different products. And that gets impact, and the consumer ends up paying, which may have an impact on the demand, because when the car prices goes up, definitely the demand for sure may be impacted as well. So that's a cyclic effect. In the long run, let's assume it continues for a couple of years and there is no change in stance. Then, of course, as OEMs and as business houses, they will have to see how do we now optimize the supply chain and which is the most important market and how do we optimize. But short run, it's more inflationary driven, and actually there would be a wait and watch to see the final outcome, then already reacting to supply chains.
As these conversations continue through the day, it's time to take a short break. But before we do that, here's some good news for our viewers. And that's, of course, India's business news leader, who is now just a click away. And that is CNBC-TV18's all-new app, where you get instant access to breaking news, financial world updates, and in-depth articles. All of it at your fingertips. You can download the app from the App Store or the Google Play Store, or even scan the QR code that's up on your screen. We take a short break. Back on the other side.
A couple of stocks hitting highs of trade. BF Utilities, an interesting one, up 6% right now as we speak. We have Snowman Logistics, which continues to do well as well. Promoters been saying that they'll be buying from the open market, so we'll keep an eye out on that one. Raymond is the other one. Of course, a large part of their business now, the Raymond listed entity, is more to do with the real estate stuff. That stock is up around 9% as well. Monte Carlo is the other one too, which is moving higher. And as we speak, just as this moment, we have a lot of these FMCG stocks which have moved to the high point of trade. So pull up Britannia, that's done well. Nestle has done well. ITC itself has moved to the high point of trade. There's just one FMCG stock which is currently lurking around the lows of today's trading session, and that's Dabur. Why is that? Because the company has gone ahead and given its fourth quarter update, and it's not a very good update. They say that the FMCG volume trends continue to remain subdued in the fourth quarter. The India FMCG business is likely to decline by mid-single digits. There are three reasons why the India business is not doing well. It's delayed winter, urban slowdown, and the weakness in general trade. Remember, Dabur was the first to call out that they are doing this inventory reset in general trade, so that could be a problem for their volumes. Turns out that's sustaining. And as a result of which, their consolidated revenue will be absolutely flat. And because of the decline in revenues or no growth in revenues, operating deleverage comes in, and they are expecting margins to decline by 150 to 175 basis points. Now, where's the problem, you would say? There is a slowdown, everyone knows about it. Problem with Dabur is that over the last 3 quarters, every time post the quarter, they have given a certain guidance and they have not met it. If you look at the third quarter, they said consumer sentiment has bottomed out. Mohit Malhotra said this on the air, said we will only see improvement from here, and they aspire to grow mid to high single digit in FY26. Mid to high single digit is what they had said for H2 at the end of H1 as well. But H2, they've grown absolutely flat. 3% in the third quarter, flat in the fourth quarter. So they are missing guidance for 3 quarters in a row. So the street is not taking that well. And as a result of which, the stock is a lot lower at a time where other companies are seeing improvement in their business prospects. Dabur goes ahead and reports this update.
Possible sore spot in what has turning out to be a rather okay or a good day for a lot of these FMCG stocks. Well, 6.5% lower for Dabur in today's session after its quarterly update. But the stock that's doing well, though, among the broader markets is GMR Airports, and that's on the back of a positive note coming in from Citi, and they've initiated coverage here, a buy recommendation there, 4% higher on the stock. Vivek is here to tell us more on that. Vivek, tell us more.
Well, that's right. So like you mentioned, Citi has initiated coverage on GMR Airport. They have a buy rating on the stock, target price of 90 rupees a share. They call it an Indian airport pure play business that they like. They call it fundamentally well placed, where they see India's passenger volume growth at 8% CAGR over FY24 to FY27. Their assets actually possess comparative advantages, and with the free cash flow cycle actually turning positive, as well as regulations turning quite positive, they like GMR at this point of time. They expect GMR to turn profitable from FY26 onwards, where core earnings stand almost 5 to 6% above the street for FY26 and FY27. This is as per Citi's estimates. They also see FY27 EBITDA, or they assign a target multiple of 18 times EV to EBITDA as per their FY27 forecast. This is double to the APAC average as far as Citi is concerned, and this is, they feel, justifiable given stronger midterm structural organic as well as inorganic growth opportunities. They expect GMR to turn profitable in FY26, number one, driven by 8% tariff growth, 2.4% tariff increase in the Delhi airport, and 7.5% per annum increase in non-aero spending per passenger across Delhi, Hyderabad, as well as Goa airports that GMR operates.
All right, Vivek, thanks a lot for that. So that's about 4% higher on GMR. We'll take a short break. On the other side, we'll get Sudeep Shah to give in some trading strategies on a day where, the Nifty's down, but perhaps not out. You're watching us here on Halftime Report, and perfect time to bring you the market setup of the day. The Nifty is down by just around 58 points. At one point was a lot lower than this, and we'll talk about that. At midday, how's the F&O setup looking? If you look at the frontline indices, the Nifty is mildly lower. The Nifty Bank is actually higher, more domestic facing, hence protected from any sort of tariffs that are announced globally. The mid-cap index is marginally lower as well. But, the frontline index, it's nearly a tug-of-war between the IT space and the pharmaceutical space. The Nifty Pharma seeing a bit of a relief rally on account of being excluded from tariffs. The IT index down 4% on account of fears of a growth slowdown or recession in the US as well. No problems for the broader markets. We've been talking about this train-like movement that we've seen in the green and the red lines, right? After this initial bout of volatility that we saw, we have advances at 1,800 stocks, declines at around 767 itself. So lows are being protected and we've seen some purchase itself. A couple of stocks on our radar. Good updates are being rewarded. AU Small Finance, for instance, up 3%. Dabur, we spoke about, weak business update coming in. That stock down by about 6%. So very stock-specific market as well. Today is also the weekly options expiry. So the Nifty 23,250 put fairly active. The street believes that maybe this could be an important support to watch out for. But on the way up, crossing 23,300 may be a little difficult because we've seen some writing at the 23,300 call itself. So just keep an eye out on this. Maybe a narrow band of 23,250 to 23,300. But were we to break that on the downside, there is a fair amount of support. Today's low, 23,145, comes in at the first support. Below that, we have the 23,000 mark, which is the 50-day moving average. And were we to fall below that as well, we have the 20-day moving average at 22,928. So short point, we're closer to supports than we are to supply zone for our market. Just a couple of stocks, fresh shots being built on mid-cap IT more vociferously than the large-cap IT names. And IDFC First Bank is one of the stocks in the financial space which is seeing a lot of long build-up taking place out there. So just keep an eye out on it.
Positive reaction to another business update. IDFC First Bank just came out with its update a few minutes earlier. Both advances and deposits growing over 20% on a year-on-year basis, and you can see the reaction there, 3% higher on IDFC First Bank. But a quick chart check with Sudeep Shah of SBI Securities, who's joining us on the show now. Sudeep, good afternoon. Thank you for joining in. Well, the initial gap down was very quickly bought into. Does this trend continue? What are the charts indicating on the Nifty? And would the Nifty Bank continue to lead it higher? And couple that up with your stock recommendations as well.
Good afternoon. Yes, I feel, today's reaction by the markets is a mature reaction. Now, last several days, we have been under this uncertainty about how the tariffs would be and what the actual numbers would be and what would be its impact on the markets. But ahead of that, Nifty had already corrected by 300 to 400 points. And that is the reason I feel today from the opening lows, we have seen some decent buying, although we have not yet managed to sustain in the green today. But overall, I feel that 23,130, 23,150, which are sacrosanct to yesterday's as well as day before yesterday's lows, were quite closer to that zone. This cluster of support zone will be a very important number to watch out for, 23,130 on the downside. So till the time we are sustaining about 23,130, there is a possibility that we might consolidate between 23,130 and 23,350, 400. But the larger trend remains now buy on dips, and I feel selective spaces would offer decent opportunities. So from a Nifty level, yes, 23,130 will act as an important support. Stock specific, if we see, there are a couple of spaces apart from banking which are doing well today. Now, a case in point is defense stocks. If you see HAL, BDL, BEL, Mazgaon Dock, all have seen some decent buying, and they're not yet impacted more with the tariff thing. Another sector is cement, where we feel that Grasim could do well. So one could buy Grasim Industries with a stop loss at 2,600 on the downside and a target at 2,750 on the upside. On the weekly charts, there is a consolidation breakout, as well as it's trading above all its important moving averages and outperforming the markets since last few weeks. So 2,600 stop loss, 2,750 targets here. The second stock that is on our radar is from the defense space, which is BDL, Bharat Dynamics Limited. Here also we have seen the stock breaking out of a long consolidation post September 2024, and the breakout is with volumes. So the stop loss here would be 1310 on the downside, and the first target would be 1420, and the second target would be 1450.
What about mid-cap IT, Sudeep? Persistent, Coforge, they're falling as swiftly as they went higher. 9.5% down on Persistent, 7.5% down now on Coforge. would you use this as a buying opportunity, or would you stay away from the sector as a whole, more so because you're heading into earnings season as well?
Perfectly put, Hamas, because we are heading into an earnings season right now, and this would be more crucial now. With the tariff thing now out of the way, we've seen what impact it has had to add on the IT stocks. So what I feel is I would be a bit skeptical getting into this IT space right now, whether it is large cap, whether it is mid cap. Mid cap, by and large, till now were kind of aloof, and they were kind of protected from the downfall. But in the last few days, even these names have participated into the downfall. So I feel wait and watch would be the right approach to invest or trade into the IT stocks from a long side perspective.
And as you can see on the charts on your screen, both Persistent and Coforge are now convincingly below their 200-day moving average. Persistent more so, Coforge still hovering around those levels or just below that. The top three losers on the Nifty 500 in today's session: Persistent, Coforge and KPIT Tech. Sudeep, thank you so much for sparing time and joining us today, though, with your views on the index and on specific stocks as well. We take a short break. Up next, we discuss the impact of Donald Trump's tariff announcements with Anurag Sehgal of PwC and Agneshwar Sen of EY India. Stay tuned. We'll be right back. Welcome back. Now, the US President Donald Trump has slapped hefty tariffs of up to 50% on his trading partners of the US, disrupting the world trade order. Now, exports from India will attract a reciprocal tariff of 27%, but less than what has been imposed on China, Vietnam, Indonesia and Bangladesh. Now, this can boost textile and electronics exports, even as drug makers have cheered being excluded from the tariff ambit. We are now being joined by Anurag Sehgal, the Managing Director at PwC, along with Agneshwar Sen, the trade policy leader at EY India. Gentlemen, good afternoon. Thank you for joining in. I'd like to start off with you, Anurag, first up. I start off with the textile sector itself, right? All the textile companies are doing very well in today's trading session. But is the fact that the competitor countries have been taxed more than India the only differentiating advantage for this sector, or do you see some other competitive advantages as well?
Thanks for inviting. And I totally agree that, the competitive advantage in the landscape, the competition landscape, would be better for Indian exporters as compared to, say, exports from Bangladesh or Vietnam or China to the US. But this may not be the only factor. What is the other factor which may be impacting the sentiments of the industry would be the fact that India is the only country with which US is negotiating a bilateral trade agreement. So what industry realizes, or what the market realizes, is that one, we competitively have got a better deal, even though 27% is a quite high figure and the landed cost would increase. But competitively, we have got a better deal as compared to our direct competition in Vietnam, Bangladesh, China, and maybe other countries. But there is further possibility of mitigating this tariff impact also, because there is an active negotiation going on. And if you see the last week's press release by the government of India, they have expedited these negotiations. And a deputy USTR was in India, and post that, specifically the press release mentions that the negotiations now will take virtually, so as to expedite the process. So in all, industry realizes this sentiment that there is a possibility of mitigating this impact further. And already maybe some mitigation has happened because of India's proactive steps. India has been taking proactive steps since budget this year, liberalizing duty on Harley-Davidson, bourbon whiskey, ethanol switches, abolishing equalization levy. So maybe some proactive steps have already gone behind the lesser tariff as compared to the other countries, though we are not totally aware of the calculation matrix. And maybe the further mitigation is in offing due to G2G talks. So maybe that is also, working on the sentiments.
Right, we take that point. What about fisheries and aquaculture? If you could comment on that, how does India stack up in exporting segments out there? Anurag's given his word. What about you, Agneshwar?
Well, if I could just continue from what Anurag was saying, I look at this as an opportunity, not just in the context of the BTA that we are now discussing with the US government. We are trying to, fast forward that. But along with this, there are two other, developments, which are as important. One is we have also put, our the FTAs that we were negotiating with Europe and UK, they also are going to help, in creating, in the new circumstances, opportunities for India. One other issue again is the huge tariff differential, and it's really huge tariff differential that we have with our competing countries. We could also see a redrawing of the supply chains within Asia itself. As you know, we are in FTAs with literally all the countries other than China and Asia, and the impact on them could certainly, be an opportunity which we could also look at and exploit. Having said that, on fisheries and there one will have to take a look, because the issues that US has been raising for putting up the tariffs has also been a variety of SPS and TBT issues, which came up in that in the foreign trade barriers report that they mentioned. So we will have to work, hard in trying to streamline those requirements, to, if possible, do away with some of them, or at least adopt, international measures. So some more concentrated action by the government, I think, will minimize any kind of a market disruption that we will see, even in the short to medium term.
Right. Anurag, there are so many other sectors at play as well, right? The electronics components is one of them as well. Other electronics in general, but what will be the duty differential here with compared to other exporters like China? If you could shed more light on that.
Absolutely. And when we were talking about competitive tariff arbitrage, one of the important player vis-a-vis with whom India is comparing is China. Say, for example, smartphone exports. Now, smartphone exports from India, and you would agree, have increased considerably post success of the PLI. So now, major smartphone manufacturers have set up their base in India and exporting from India. Though smartphone exports will now attract 27% tariff when they're exported from India to US. But compared to that, if you consider exports from China, they will attract 34%, which will be layered on top of the 20% which was imposed earlier in the months of February and March. So 54% as compared to 27%, that is just half of what China's exports of smartphones will attract. So in smartphones and for other electronic component sectors also, there is a considerable tariff arbitrage advantage which Indian companies will enjoy. Here, one more important point to note is that while the aim of the US of bringing in these reciprocal tariffs is clearly twofold. One is to reduce the trade deficit with the countries, and second is to increase manufacturing and increase jobs in India, or manufacturing related jobs in, US. The reason is very clear. They are trying to reshore these jobs to the US. But having said that, what they have done is, whether it is electronic components or smartphones, that is smartphones components as well as smartphones, they are kept at same rate, that is 27%. So this will not incentivize manufacturing in the US. In any case, incentivizing manufacturing in US will be a long drawn process. So in that sense also, India will be benefited, and you would rather see US businesses backing India's ongoing negotiation with the US, because they would want us a reliable supply chain trade partner in the form of India to be exporting to the US market.
Right. So, what happens from now is a function of how the negotiations play out, whether this gets implemented or not. And if anything, it just opens the room up for discussion a little more. Anurag, it's a big list of exempted products that are there in the Annexure 2. Which ones do you think are important for India? That's point number one. And second one, are there any relevant items for India in the HST-US exempted list?
Yes, absolutely. If you see India's export basket, out of top 5 export items exported by India, 2 are exempted: pharmaceuticals and petroleum products. And
Yes.
if you see all the exempted items, then close to 20% of India's ongoing trade with the US, that is the export factor of it, is exempted. So what this does is, while other countries would want to enter into a negotiation with the US to protect their 100% export basket, India already has 20% taken care of. Now, what remains is 80%, on which a lot will depend on G2G communications, which are going on in the form of BTA. And of course, a lot will also depend on how India provides avenues to the businesses to diversify in the form of, like my co-panelist was saying, in the form of other free trade agreements with Middle East, with UK, with EU.
Final word from you as well, Agneshwar. Since you mentioned the tariff exemptions on products, as Anurag was mentioning, is there any relevant items for India in the harmonized tariff schedule as well, if there's something that needs to be given attention to?
See that two things. One is I've been, of course, watching, these exemptions, pharma and petroleum products, as he mentioned very, very clearly, they are of interest. But, we have to also take into consideration some of these other statements, where they mentioned that, some of these would be looked at in a sectoral kind of a format, that is pharma, the copper, semiconductors and things like that. So I think some more transparency is required on three aspects. One is, of course, the taxation legislation, which is winding through the US system. We'll have to see what the domestic taxation regime is put in place, because that will really determine, whether they're really looking to, say, shift the supply chains from one country to another, or, to onshore it in a serious way. Given that, they're saying that they need both revenue and jobs in the US and to have the factories shift to the US, we would also have to perhaps take a look at, partnering with the US firms and firms which are setting up manufacturing there in a serious way. So, yeah, this is how to put it, the paradigms have changed pretty drastically. So we'll have to take a look at the opportunities that come in. And this could certainly be other sectors, than the ones which we are traditionally been focusing on.
All right, final word from you then. We'll just get one from PwC. Just, Anurag, on, what sectors, apart from what we've discussed so far, stand to get impacted the most? Just simple for our viewers.
So sectors which will get impacted the most would be electronics, smartphones, fishery exports, gems and jewelry, auto components were already covered, but certain other machineries. All of these sectors of India's export interest, rice, textiles and apparels, all of these sectors will be impacted considerably. And the businesses in all of these sectors will be looking at two things. One, G2G communications in the form of bilateral trade agreement. Second, what they themselves can do in the competitive landscape. How can they diversify their products? How can they make their products more cost effective? So these will be considerably affected sectors.
Follow up quickly, do you see an impact on the shrimp sector as well? Because they are also a major exporter to the US.
They are already impacted. So 27% tariff has been imposed. So India exports a lot of frozen shrimp. So this sector is clearly impacted. And this sector would also be relying a lot on the BTA, not only for tariff mitigation, but also for some other ways to incentivize their exports to the US, say in form of a mutual recognition agreement, which lowers down the non-tariff barriers. So this sector would be, eagerly looking at the bilateral trade negotiations because they are clearly affected.
They're clearly affected, and how you can see that in the stock prices as well. Avanti Feeds down 18%, Apex Frozen also down 6%. But gentlemen, both Anurag and Agneshwar, thank you so much for sparing time and joining us to decode this major announcements made by Donald Trump in the early hours of a Thursday morning. Thank you so much for joining in. We take a short break, but before that is a small programming note for our viewers. CNBC-TV18 and HSBC India are back with Season 2 of the SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are now open. You can scan the QR code now and submit your entry for the SME Champion Awards Season 2.
Look at Power Grid. That stock's moved higher. So we have a couple of these stocks which are doing well. Again, a domestic play here moved to the high point of trade, recovered about 4% from lows. In fact, it's not alone. We have NTPC as well, which has done well. So that's moved higher too. So we have about a couple of power-related stocks which are doing well. And then you have some others as well. Ramco Cements is doing well. Astral is moving higher. Prestige Estates continues to recover from lows. HFCL, the latest F&O entrant as well, has moved higher too. But is the financial space which is doing well in today's trading session. In that, an underperformer is Bajaj Finance, because we learned from sources that the RBI has sent a letter of displeasure to the company on its co-branded credit cards. Vivek joins in with the exclusive details. Vivek.
Well, that's right. So what we understand is that, RBI has sent a letter of displeasure to Bajaj Finance on co-branded credit card business. The RBI communication cites earlier letter dated both Jan 31st as well as Bajaj Finance's response dated February 22nd. What are the key observations of the letter? The RBI letter says that the company proactively has not identified any gaps or vulnerabilities. They flagged significant risk to customers. There are also communication that is pointing to reactive approach, failure to maintain adequate internal controls. The RBI letter also has gone ahead and contested Bajaj Finance's claim that his role was simply related to customer solicitation. They say that Bajaj Finance has an integral role in co-branding arrangement and also has access to sensitive customer data. RBI letter also argues that Bajaj Finance cannot absolve itself of responsibility to partner banks as well as customers. What are the key RBI directives? Number one, the Bajaj Finance now needs to monitor as well as ensure adherence to timelines. Company must also seek independent validation through external audit along with prior RBI approval. The audit also must cover data security measures as well as IT and cyber security related controls. Now, very importantly, RBI has clearly directed Bajaj Finance, saying that it now needs to obtain explicit approvals from the Department of Supervision of RBI if it intends to re-engage in co-branded arrangements. Now, what is important to note is that the current RBI rules does not explicitly need any NBFC and bank to take permission from the RBI before going into an agreement. So again, this is something that is a bit of a concern for Bajaj Finance. We reached out to Bajaj Finance. They've not yet responded to our queries to understand the impact. Remember, they have co-branded agreements both with RBL Bank as well as DBS Bank. The company said that it will cease incremental sourcing of co-branded credit cards with RBL Bank as well as DBS Bank. Important development, stock at the day's low.
Stock at the day's low, almost 2% lower now is Bajaj Finance, cooling off from the record highs that it had made in the month of March. What is also at the day's low now is Persistent Systems, and Midcap IT continues to get hammered in today's session. 10% lower now on Persistent Systems, continues to remain the top loser on the Nifty 500. Coforge is now down 7.5%. KPIT Tech also down 7.5%. What's also at the lowest point of the day though is Navin Fluorine, and that stock is now down 7% as we speak. Among the chemical names that have seen an impact in today's session, Navin Fluorine, one of them, and SRF continuing to maintain losses of around 4%. We take a short break. On the other side, Manisha Gupta joins in with Shaunak Parikh, the Vice Chairman of the Gems and Jewellery Export Promotion Council. Stay tuned.
Welcome back, and joining us now on the show is Shaunak Parikh. He's Vice Chairman, DJPC. Mr. Parikh, hi, thank you for joining in. And a lot of problems right now and a lot of confusion right now as well as far as we read those numbers. First of all, would want to understand if you as DJPC understand if 27% is going to be the total tariffs or 27% plus the existing tariffs.
Hi, Manisha. Thanks for having me. Yes, there is some amount of confusion as we speak. The team is actually looking at the fine print, trying to really understand what it is. There is no 100% clarity yet. I think soon we will have whether this is addition to the existing tariff or is it flat 26. So I think in some time we'll have that clarity.
Mr. Parikh, the other thing is that the last couple of years, Indian jewelry exports to US have been slightly on a weaker side. And in addition to these tariffs now, where does the industry see itself?
So we believe there will be short term, there will be some impact with all the tariffs. But we are very confident that the Indian government and the US government will work out a bilateral trade agreement, which is in the process. And once that is negotiated and signed, we believe I think it will be normal days. But it will take some time to learn.
Mr. Parakh, also when we look at the overall numbers, would India be then looking at countries apart from US as well? Where do you see better growth coming in? And even putting that question aside for a second, if you look at the other jewelry makers like Turkey or Egypt for that matter, Singapore for that matter, these countries have much lower tariffs at 10% or thereabouts. Would India lose out to these other manufacturers then?
So two things, Manisha. One, yes, there's anyways a continuous efforts from the council and the trade to continuously grow other countries around the world. The likes of Latin America, there are Far East countries. So we are continuing. Our efforts have been there to continuously grow that business. Secondly, in terms of competition from other countries, as you mentioned, India has a certain advantage in terms of skill set, in terms of manufacturing. And the other countries, they have their own strength. Having said that, we are again hoping that the negotiation will get sorted and time will come back to normal. If it doesn't come, there is a possibility of business moving to other low tariff countries. But we are hoping that that won't happen.
Oh, well, absolutely, Mr. Parakh, because a UAE and a Singapore and a Turkey have 10%, while India is 27%. And as you said, it's not very sure whether it's 27% plus the current or not. Do you see a lot of Indian businesses then moving out to these better competitively placed countries?
Long term, if it doesn't get sorted, that is, yes, a possibility.
Mr. Parakh, by how soon do you see a clarity coming in on this? Because at this point in time, the markets really seem to be working with both these numbers, whether it is 5% plus 27 or is it overall 27. By when do you see this clarity really coming through?
Well, that should come, I think, we are hoping before the end of the day or at the most, I think another day or so. So we are already working with the legal team to look at the fine print.
As you mentioned about the bilateral trade that both the countries are talking about, and we do understand these are high-level conversations already on, what is it that the jewelry industry, or as DJPC put its recommendations as?
So we have already proposed to the government to lower some of the tariffs that we have to import, for example, jewelry, loose diamonds from the US, and bringing it, so overall bringing it in line with the duty that we have compared to the US. And by largely, we agree, and the government kind of agrees with the thought process. And hence we are very, very hopeful that as far as gem jewelry is concerned, we should be able to have a fair trade on both the sides.
Mr. Parakh, what is the trade volumes right now with the US vis-a-vis other countries? And does US continue to be the largest destination for Indian jewelry exports now?
It is one of the amongst the largest destination, yes, with roughly about 10 billion going to the US.
And how much would that come to in sense of percentage terms? Is it like half your market?
So again, depending on the category, like loose diamonds would be roughly 35%, jewelry would be 50%. So again, each category kind of differs.
But in overall scheme of things, would you say it's 50% or more?
No, it would be roughly about 35-40% of the business to US.
So that means that with the kind of tariffs that are coming in would be a big hit if that doesn't get sorted, would you say, Mr. Parakh?
It will be, as I said, big at short term, but long term we should be able to resolve it. That's what the hope is. Yes.
My final question, Mr. Parakh, a lot of sectors are talking about maybe the supply chain, the route of business will change. Do you see that happen with US as well, with India and US?
it can happen. I think the way things are going on, it can change the supply chain. Having said that, this can also open up opportunities for India as a country, because also a lot of the other manufacturing countries have higher tariffs than India. So we could possibly even be at an advantage at some point of time.
Fair point that, Mr. Parekh. Thank you so much for joining in with the sense. And as you said, the next 24 hours are going to be important as we get more clarity on those final numbers there. But thank you so much for joining in with your sense. And with that, it's a wrap on Halftime Report. Business Lunch Day calls the action again.